look at the data on mortgage applications that we got yesterday. The purchase index was down 8%, and that's following a 3% decline the week before. And the refi index was down 9%, following an 8% decline the week before. Mortgages and refinances are plunging, and this has major implications for the economy. First of all, Wells Fargo just announced major layoffs in its home lending business. Why? Because people aren't able to do any refis, so they don't need all these mortgage agents if people can't refinance their mortgages. Because where are mortgage rates? The mortgage interest rate is now so high in relation to where it's been that there's nobody who can now refinance their mortgage into a lower rate, because everybody's got a better rate than what they can get now. And that Refi Lifeline has been a major lifeline for the economy, because it's given households a source of income, because you only refinance your mortgage if the result is a lower payment. And if homeowners are able to lower their payments through a mortgage refi, then they have extra money to spend, because they're not spending it on their mortgage. They have more money to go shopping or whatever, and that additional spending goes into GDP. It also helps employment in the industries that are the beneficiaries of that spending. So this has been helping a bubble economy, an economy based on consumer spending. If consumer incomes are freed up from having to make mortgage payments, they have more money to buy other things. Well, households can't do that anymore. Whatever your mortgage is, you're stuck. You're not going to be able to reduce it. And in fact, for a lot of people, their mortgages are going to be going up, because you still have a lot of adjustable rate mortgages out there. I'm not sure the exact percent, maybe something like 15-20% of the mortgages are adjustable, and they're not necessarily adjustable every year. A lot of people took out 5-year fixed, where after 5 years it adjusts. Well, there are a lot of people that did that 5 years ago, and now they're getting up to their adjustment period, and their rate is going to adjust way up. And now they're going to have to start spending more money making their mortgage payments, which means now they have less money to buy food, less money to buy gas. Of course, food and gas cost even more. So chances are they're going to have to cut back on other discretionary items, which is why a lot of these consumer discretionary stocks have been having so much trouble. But we already have this anecdotal evidence of a weaker economy. Even more news today, weakness in manufacturing. The Kansas City Fed Manufacturing Index was supposed to come out at 39. That was going to be an improvement. Instead, the number was way below the consensus range. So there's ample evidence that the economy is much weaker than everybody thought. And that is especially true when you look at the GDP number that confirms this. Now, of course, one of the biggest factors driving the GDP down was America's record trade deficit. We actually got the merchandise trade deficit. Now they call it the goods deficit. We got the advance estimate. So this was the final month of the third quarter, and this definitely weighed on the number. This is just goods. This doesn't include our surplus in services that reduces the overall deficit. But this is the big deal. This is the manufactured stuff. Remember, when Donald Trump ran for office to make America great again, it was because of our merchandise trade deficit. It was manufacturing. He campaigned to make America great again by rebuilding our industrial base, our manufacturing, because we were losing on trade because of these big trade deficits. Not only did it not contract the way the experts expected, but it skyrocketed to 125.3 billion, shattering the old record, miles above the consensus range, which went from a low of 103.7 billion to a high of 106.6 billion. This is a horrific number. I mean, nobody has ever seen anything like this number. I mean, the only thing more amazing than this number is the market reaction, because the dollar went up. I mean, once upon a time, a number like this, not like we've ever seen a number like this, the dollar would be killed. Instead, the dollar went up. Gold got hammered on this news. Nothing that should have happened did happen. The markets are still completely clueless. Normally, the currency of a nation with such a horrific trade deficit, its currency would be punished, because that's the way to get rid of the deficit. The currency crashes and now you can't afford all the imports anymore. And now your exports get a lot cheaper to foreigners and it helps bring your trade back into balance. But America is not being disciplined the way a normal country would because we have the reserve currency. You see, how did we pay to import $125.3 billion worth of stuff? We paid for it with dollars. We imported stuff and we exported dollars. See, dollars are America's greatest export, except they're worthless. We just print them. We create them out of thin air. They have no value. The stuff that we're getting has real value. You need factories, machines, workers, land, all sorts of materials go into the production of finished goods that Americans are importing. And what are we giving our trading partners? Digits that we create out of thin air. Why do they do that? What is the world doing with all these dollars? What are they going to do with the $125.3 billion they just earned? I mean, I know what we're going to do with all the stuff we just bought. We're going to enjoy it. We're going to have fun. We're going to use all these products to make our lives better. What is the world going to do with all this paper? Right? Well, they're just going to hold on to it. They're going to buy more of our paper. But the more they buy, the less it's worth. Eventually, it has to collapse. Right now, the dollar is benefiting from this flight to safety, from problems in Europe, problems in Japan. But this is a huge bubble. It can only end in disaster. The higher the dollar rises, the more spectacular the collapse is going to be once reality sets in.
When do you think the breakout point, like the latest data is showing that new mortgage applications are down like 40% or something, and the market's starting to take a hit. The IMF says that interest rates should be at least 1% above the inflation rate. So that would mean if we're at 8% now, our interest rates should be at least 9%?
I would want more than 1% above inflation because that's not a good enough return. I mean, 1%, there's negative interest rates everywhere. I think they're the most negative here because we've actually got the highest inflation. So even though we have higher nominal rates than what you would find in Europe or Japan, we have lower real rates because our inflation rate is higher. And of course, that's the unofficial. The real inflation rate is quite a bit higher than that. But look, when mortgage rates go up, and now they're back up to about 5%, and historically that's still low. But in recent years, they've been well below 4. I mean, people were getting mortgages below 3.5% on 30-year fixed. And if you look at home prices, because they're up like 20% year over year, home prices are at record highs and home affordability is at a record low. And that's before interest rates go up. So the only thing that's keeping these overpriced homes marginally affordable is the low mortgage rates. But if you take away those low mortgage rates and mortgage rates move back up to maybe 7, 8, 9%, which was normal, before the 08 financial crisis, we get mortgage rates back there, something's got to give. Otherwise, nobody can afford to buy a house. And what's going to give are the home prices. Home prices are going to crash. But what's not going to happen, though, is new construction because inflation is driving the cost of building new homes through the roof. So we're not going to get any new homes. If you want a home, you're going to have to buy one of the homes that already exists. But if you don't have any money and somebody wants to sell you a house, I mean, the price is going to have to go down. At some point, real estate could become an all cash market because most people may not even be able to qualify for a mortgage.
When do you think, what interest rate do you think, when the Fed gets it and goes to, that it's really going to bring down the markets and the economy?
Well, I think we're already there. I mean, I think the market's already broke. We just haven't collapsed yet, but I think we're headed lower. The bond market clearly broke. But if you go back to 2018, the wheels really came off the bus in the fourth quarter of 2018.
I remember.
The Fed got rates up to about 2.25, 2.5, and then they had to stop hiking. And then they had to stop quantitative tightening. And they ultimately went back to zero in QE in March of 2020 with COVID as the excuse. This time around, I think the breaking point is much lower than what it was in 2018 because the breaking point is a function of how much debt you have. So the more debt you have, the bigger the impact an increase in interest rates is, and the lower the increase has to be to create that impact. So because we have so much more debt now than we did before COVID. The economy is more levered up and more dependent on cheap money. As that money becomes less cheap, you're going to have a collapse quicker. It's like we have a much bigger drug habit now. And because this drug habit is so much bigger, we're going to go into a relapse and withdrawal much sooner with an even smaller reduction in the dose of our, monetary heroin, which is where we're headed. So 150 basis point rate hike, that might do it, The only thing that's propping up the commercial real estate market is the cheap money, because the rental income is not there. And it's obvious that more people are going to work from home. The commercial real estate sector is going to get decimated, as too will retail, because people aren't shopping. They're not going to be able to afford to shop because the dollar is going to lose so much value. Going to Walmart will be like going, to Saks Fifth Avenue. People aren't going to be able to afford to go shop there anymore. But to the extent that people do shop, they're buying stuff on Amazon or other online retailers. They're not going to malls and shopping centers. And all of these places are in tremendous trouble. And so are the banks that loan money to the owners of these properties, because they're going to default. So this is a tremendous crisis that's coming. The real estate that will gain the most value will be like farmland, land where you have natural resources that you can harvest or grow, and maybe land out in the suburbs, as a lot of people are fleeing these crime-infested, overtaxed cities where they no longer have to work because they can work from home. So you could see a dichotomy between real estate in the inner city and real estate out in the country or the suburbs. The markets are in the eye of a hurricane here. And the way the markets are looking at inflation right now in the Fed, the markets still believe that the Fed will be successful in its inflation fight, and that this big uptick in inflation will in fact end up being transitory. It's just a longer transition than they may have first thought. But the markets still believe that inflation is going to stay around 2% or lower over the next 30 years. And you can see that by looking at yields on 30-year bonds. You can look at the spread between Treasury inflation protected bonds and regular Treasuries, that the markets still expect low inflation over the next 30 years, despite these massive deficits. And they believe the Fed can continue to print all this money, do all this quantitative easing, that the balance sheet can grow forever, and none of that is ever going to translate into higher inflation. And I think that's pie in the sky nonsense. And I think soon the markets are going to have to come to grips with reality that the Fed is going to lose the inflation fight. It may not even really have the fight. It may just be bluffing, but ultimately not even have the guts to get in the ring with inflation based on the political sacrifices that would be made short term for the economy and for employment and for the federal budget deficit. Because if the Fed fights inflation, the U.S. government is going to be forced to dramatically cut government spending, including spending on Social Security, Medicare, and things like that. And so to spare politicians from having to make those tough choices, it's likely that the Fed never follows through with this, and we go back to QE and the Fed starts cutting rates again, even as inflation remains high. But when the markets realize that inflation is not going away, and even if we have a recession, inflation is not going away, a lot of people think, well, if the Fed doesn't win the fight against inflation, recession will, because the Fed's going to raise rates high enough to cause a recession, and the recession is going to get rid of inflation. It won't. The recession is going to make inflation worse, because in the recession, we're going to have less economic output, but we're going to print even more money. But when the markets come to terms with just how high inflation is going to be, there's going to be a rush into gold and silver like you've never seen. Prices are going to crash up, not down.